What's up everyone, it's Karthik with MoneyVest. Welcome on board for our Market Open live stream. Two big fintech stocks just reported their earnings, Sofi and PayPal, both having an opposite reaction to the earnings. Sofi is up a little bit over 2% on a double beat on both EPS and revenue, and PayPal here is down over, well, actually recovering. I literally just looked at it a couple minutes ago. It was down over 10%. You can probably see that on the 5-minute chart. You can see how quickly it's been bought back up here. So we were pretty much down a little bit over 14% at one point for PayPal here. And then of course, very, very quickly getting bought up from $72 back up to over 81. So that's a 10 to 12% increase in just a span of 3 minutes. Still down over 3%. However, SoFi is the one that's actually pushing up over 2.4% right now. I haven't looked at the earnings yet. All I have for now is the beat on EPS, $1.20 per share from PayPal. That's the earnings per share number, $1.20. Revenue came in at $7.8 billion, so slight miss in revenue, beat on EPS. And SoFi coming in with a double beat with 5 cents in earnings per share, so very strong profitability. And revenue with a massive beat. That's about a $50 million beat here at $689 million. Should not be billion. That would be ridiculous. But $689 million was the revenue number, 5 cents in earnings per share. Beats on both accounts for SoFi, miss on revenue for PayPal, but a beat on EPS as well. So SoFi is up almost 3%. Very, very nice move to the upside, and PayPal is still trying to recover. It's actually quite crazy, the volatility, the price action. It was down over 14% at one point. I mentioned this in the Discord literally a couple minutes ago, that PayPal is down over 10%, and look at that, very quickly recovering back to the upside, only down less than 2%. So if you guys can see me and hear me, just give me a thumbs up, do me a favor, and share this live stream with everyone, friends, family members, everybody, so that they can join us and we can take a look at these numbers. So by the way, SoFi coming in with revenues of $697 million. That's a 30% growth on a year-over-year basis. Net income also sitting at over $60 million. And if you do some very, very simple math here for the company's net margins, we're looking at 60 divided by 697, and we've got ourselves an 8.6% net income margin, and adjusted EBITDA sitting at $186 million, which of course is even better in terms of that margin at over 26%. If you come over to some of the presentation, we can kind of take a look at the numbers. So again, Galileo accounts growing here, products at 13.6 million, members at over 9.3 million, up over 35% on a year-over-year basis. Galileo accounts again accelerating up to 160 million accounts, at 17% year on year. And then of course, if you scroll down a little bit further to take a look at the performance, we've got total originations at $39 billion from the first quarter 2020 all the way to second quarter 2024. And then, of course, we got a 43% remaining order book with quarterly performance sitting at $689 million, adjusted EBITDA with a 26% margin. And this right here is really where most of that momentum is coming from. This is the trailing 12 months. As of third quarter 2024, the company has now done over $214 million in net income in the bottom line for the company. So this is where the momentum, a lot of that momentum is coming from. Of course, short sellers continue to write off the stock here. And now the guidance, if you take a look, we've got the updated revised guidance. So net revenue $689 million versus the original guidance of $625 and $645, representing a $44 million beat on the higher end. And then now look at this guidance here on the low end, 625, 645, of course, a huge beat. But moving forward, financial services net revenue growth of more than 80% versus 2023 levels. Lending adjusted net revenues of at least 100% of 2023 numbers. GAAP net income of $204 to $206 million. This is literally their fiscal year 24 guidance. And we can actually plug in some of these numbers for ourselves to better figure out what's the fair value for SoFi. I've talked about this on the channel before because we really do need the bottom line earnings in order to calculate what the fair value might look like for the business. And it's actually part of my shopping list. So it's going to be released at the end of this month, so either today or tomorrow, where our developers are working on it. And the shopping list is going to be available on the MoneyVest website. And SoFi is, of course, going to be part of it with my fair value as well. But $204 to $206 million is the GAAP net income expected from SoFi. That's what they're going to deliver, with revenues expected to be at 2.5 to 2.55 billion and GAAP diluted earnings per share between 11 and 12 cents per share. And this is exactly what we also have on our platform. So if you come over to SoFi, you'll notice under fundamental analysis, analyst estimates, we've got a forecast of 11 cents. You can see 11 cents is the average. Low is going to be 9 cents. High is going to be 17 cents. So 11 cents is what everyone, even on Wall Street, is expecting from SoFi to deliver. Of course, we got a hold rating with a low target of $4, average 8.55, and a high target of 12.60 on this company. So it's good that we've got this guidance. We've got very nice GAAP profitability from the company, and we can take a look at how that's going to play a role in SoFi's future, right? What's going to be the fair value? What's going to be that growth moving forward as well? PayPal, we're going to take a look at in just a minute. I know there's going to be a lot of people interested in PayPal as well, but SoFi, take a look, up almost 6% right now here on the day pre-market, pushing up to 11.82, hitting a high of 11.99, just shy of $12 per share. So massive momentum coming in from SoFi, and PayPal, of course, moving in the other direction, which is down a little bit over 2% right now. So make sure that you drop a like, everyone, subscribe to the channel. And I know it's a super early live stream. A lot of you guys may not have, of course, you're not up yet, but definitely do me a favor, drop a like, subscribe, and share this live stream, because we've got the earnings call starting in an hour. It's going to be starting at 8 a.m. Eastern. So we've got well over 40 minutes to analyze SoFi, PayPal, look at the price action, look at the pre-market, before we can listen in on the earnings call, because I believe it is going to be, let's see, earnings webcast is going to take place, I believe, at 8 a.m. Eastern, which is going to be just about less than an hour here. But let's see. Yes, it's going to be at 4 p.m. for me. Yep, so just about an hour here that we got to wait for the earnings call to begin for both PayPal and for SoFi. Now, the decision that we have to make, of course, is whether we're going to be listening in to PayPal or SoFi. I know there's going to be a lot of interest for SoFi's earnings call, but I feel like PayPal is also going to give us some pretty good insight into their business. But coming over to PayPal now, so third quarter performance from PayPal. We're just going to scroll down a little bit on the numbers. So total payment volumes coming in at $422 billion. That was up 9% on a year-over-year basis. Revenues, 6% year-over-year growth at $7.8 billion. And I think part of that reason might be their take rate from PayPal might be taking a little bit less of the total payment volume, because if TPV is up 9% and revenue is up 6%, that is a clear signal that their take rate came down. $3.6 billion in transaction margins, up 8%. Then we got non-GAAP EPS sitting at about $1.20, 22% increase. Free cash flow sitting at $1.4 billion, up 31%. Active accounts, 432 million. So active accounts grew 0.6% or plus 3 million sequentially, and includes growth in PayPal merchant and consumer accounts. And this is exactly what everyone wanted to see, to be honest, because PayPal's active accounts have been going down, and that's been one of the reasons why the stock's been performing so poorly, is because active accounts have been declining quarter over quarter. I don't know if they've got a bar chart. They usually do, or at least they used to have a bar chart for the active accounts here. But let me see if I can find it here. Active accounts. So, of course, in the last 3 to 4 quarters, we've seen active accounts continue to come down, and that's been one of the biggest reasons why the stock's not been doing so well. There we go. So it's not a bar chart, but it is going to be it's going to be a table that shows you the active accounts. 426, 429, stabilizing at 429, then 432, 435. And then this right here is where that flip happened. This was at the end of 2022, beginning of 23, from 435 down to 433, down to 431, down to 428, down to 426. So that's 4 consecutive quarters of declines here. And then we had, of course, the change in management. Alex Chris came in at, of course, 427, 429, and we're back up to 432. So this was going to be a priority for the new management and driving profitable growth. And as a result, we're seeing the monthly active accounts also increase to 223 million, which is the highest level that we've seen since fourth quarter 23, which was also the peak here at 224. And I think in the next quarter, we may see that number also get pushed up to 225 or 226 million monthly active accounts. So, and again, 432 is where we're at. 435 is the all-time high for PayPal from an active accounts standpoint. So, we're obviously going to see that number also eclipse moving forward as PayPal drives more engagement and more growth. Transaction per active account continues to be very strong. So, it's increased from 45 to now sitting at almost 62 transactions per active account. So it's really good to see that they're prioritizing both active account growth and transactions, which is engagement. And of course, from quarter over quarter, up from 60.9 to 61.4. And then of course, if you come down here, so this is going to be the take rate situation. So we've got total payment volume sitting at 422 million. And then if you come down on the transaction revenue, of course, $7 billion, total revenue at $7.8 billion for the company as well. So again, that simply suggests the take rate did come down a little bit here. There we go. So transaction take rate, negative 4 basis points compared to 3 basis point decline in second quarter. Benefiting from PSP volumes and Venmo, offset by branded checkout, FX, and other merchant services, payouts and stuff. So, as a result, I think the stock, of course, coming down a little bit. Let's see if you have anything on the guidance here for fourth quarter. Usually it is on the presentation. Let's come down a little bit. Again, that's their numbers, margin, profitability. There we go. Guidance here. So we're looking at fourth quarter 24 guidance, low single-digit growth in revenues, and GAAP EPS about $1.03 and $1.07 in earnings per share, and non-GAAP EPS in low to mid-single-digit decrease. And fiscal year 24, for the entire year, they're looking at non-GAAP EPS for high teens growth. We're looking at 18-19% growth here, sitting roughly at $3.92, $3.96 on a GAAP basis. This is their October guidance, which was also increased from their July guidance. So July guidance was around $3.88, $3.98. That's been increased up to $3.92 on the lower end, and then of course coming off by 2 cents on the higher end, but also increasing it from low to mid-teens to high teens growth for the company. So I think overall, PayPal also did pretty well. I think it's, apart from the transaction take rate, which came down a little bit for PayPal, I think overall, they had a strong beat on EPS. Active accounts grew finally for 2 consecutive quarters in a row. We did see transaction per active account, so both active accounts and engagement grew in the right direction. Guidance was revised up, so there was a lot to like there for PayPal from the initial assessment that I'm just doing here on the fly. And it's only been 18 minutes since the report came out. So, we had this huge sell-off at $73, then a nice little recovery. And of course, Sofi absolutely crushing it on earnings per share, on revenue, and also increasing their guidance moving forward. So there's a lot to like for Sofi as well. Now, in terms of some of the product highlights, let's see. Home loans saw the best refinancing quarter since the second quarter 22. And I think this is really what people were hoping for. And I think this is really where most of that profitability also comes from, because home loans tend to be a lot more safer compared to personal loans or even student loans for that matter. And this was their best refinancing quarter since the second quarter 22, on the back of course, interest rates also coming down by 50 basis points. And I'm sure loan officers, lenders all over the US have just been calling homeowners to refinance and get locked into a lower rate. And as a result, we're seeing a much better refinancing activity. Home purchases and refinancing grew 23% for obvious reasons as rates come down. Home equity loan volume grew 44% from the prior year period as well. So overall, I think pretty strong numbers from both of these companies. Again, Sofi having a lot more momentum to the upside for obvious reasons, and PayPal here still struggling a little bit more so towards the flat side here. And again, guidance and outlook for the full year 2024, management now expects to deliver. We've already gone over it, 2.53 to 2.55 billion, which is $85 million higher than the prior guidance, and implies a 22 to 23% annual growth versus 17 to 19%, and EBITDA 640 to 645 million above the prior guidance, and of course GAAP profitability, GAAP EPS of 11 to 12 cents per share above the prior guidance of 9 to 10 cents per share. So all in all, I think both companies, both fintech platforms here, PayPal and Sofi, coming in with some very strong numbers, and revising their guidance to the upside, both on revenue and earnings per share. So that's good to see, and continues to be a very, very strong leader. Sofi has more tailwinds, of course, because it's just turning the corner towards profitability. Interest rates are coming down, so there's going to be more activity for home refinancing, home purchases, student loans refinancing as rates come down, as well as personal loans have also been picking up. So Sofi definitely on the better foot here, up almost 6%. But of course, there's no comparison. They're both offering different products. PayPal more towards peer-to-peer payments, merchant services, consumers, and Sofi more towards lending and borrowing. So that's where we have SoFi up almost 6%. Very nice move to the upside. Now, the real question is, which earnings call should we listen to? Because they're both going to happen at the same time. I think they're both going to be starting at 8 a.m. Eastern. Alex Chris and Anthony Noto, they're both going to be talking. Obviously, we can't listen to both of them. So I'll be doing some polls to kind of ask you guys which one you all are going to be most interested in. If it's going to be Anthony Noto or Alex Perez, just let me know in the chat, because like I said, we can't play both of them at the same time. But pre-market, we've got Nvidia slightly down, Tesla slightly up, QQQs are flat, S&P also very, very flat at the moment, down about 11 basis points right now. And volatility here is just back above 20, so up over 1.2%, with crude oil prices recovering a little bit back to the upside, validating that support in the low mid 60s at the moment. Okay, overall, just as part of your analysis, can you look at the next levels of resistance for both? Yes. So I've already mentioned this about SoFi on the daily time frame. 1170 was that next level of resistance, but seems like we've already broken past that level, and we're almost up to $12. And the next target for SoFi and the next resistance really is going to be at 1390. So 1390 is going to be that next target to watch, with a support level, of course, sitting right about here at 1170. So 1170 is going to be that support, resistance up to 1390 for SoFi, right? So that's going to be that next target. For PayPal here, we've got the support level at $81 with a resistance up to $88.91. Pre-market, of course, it was trading down to $72. It was like all the way down here. Blew past a lot of those support levels, but then, of course, quickly got bought up very, very quickly. And the support level is now going to be sitting at $81. Pre-market resistance all the way up to as much as $88, $89 for PayPal. So that's where we are. Let's listen to SoFi call, PayPal earnings call, please. So there we go. Like, there's going to be some disagreement there, but we only can pick one. So I'll do a vote. I'll do a poll here in the next 30 minutes or so, because we don't have the earnings call starting in at least 30 minutes. So we've got some time to discuss. And then, of course, we'll kind of listen in to the earnings call, and then take a look at the pre-market open as well, and how other fintech stocks might be reacting to the news that just came out, to the earnings that just came out. So we've got fintech platform here. So MasterCard flat, Visa is flat, SoFi, of course, up almost 6%. Then we've got Ally down about 34 basis points, PayPal still down 2%. Square is flat right now. Upstart is up 70 basis points, and Affirm is also up about 30 basis points. So not a lot of movement in some of the other fintech / lending platforms. But other than that, of course, we got the two big, most retail-oriented stocks, PayPal and SoFi, definitely moving. PayPal is more influential than SoFi. Yes, PayPal is definitely more influential in terms of market cap, but I feel like there's going to be a lot more interest in SoFi's earnings. So we'll do a poll here. Don't worry. We've got 35 minutes. We'll do a poll leading up to the earnings call. We just wanna wait for more people to join in, and then we'll see which earnings call we can listen to. Of course, eventually I'll listen to both. So I'll kind of do a recap to whichever one we don't listen to. I'll of course listen in at my own time, and send out some updates in the Discord, kind of sending my remarks and everything else, like in terms of the summary. But if they're both happening at the same time, of course, we can only listen in on one. Okay, so what did you guys think in terms of the numbers? Overall, I would say that very strong numbers. We kind of expected the overall growth for revenues and for earnings to continue, and the guidance revision up was also very strong. Personal loan record originations of $4.9 billion in the third quarter 24, up 26% year on year. Increased 17% sequentially, inclusive of $1 billion originated on behalf of third parties for our loan platform business. So absolutely crushing it on the personal loan, on the home loan, record revenues coming in since second quarter 22. And student loans, we got to read a little bit more about that as well. Student loans were slightly down, 5% on a year-over-year basis, $42.7 billion, or actually $1 million. That's going to be in thousands. So that was the number for originations. Home loans at $284 million, basically flat year on year. And then we had personal loans also at $25 million. That was up like 3% year on year. SoFi's credit discipline continues to result in strong credit performance, as observed on the cumulative net losses of several of the company's personal loan vintages, relative to 7 to 8% maximum life of loan loss assumption, in line with our underwriting tolerance as well. Yes, Bitcoin's been crushing it. It's pushing up to over $71,000 for the first time in over 4 to 5 months. The last time you saw these levels were back in June of 24. So it has been well over 4 to 5 months here for Bitcoin to be trading well over $71,000. So very, very close to near all-time highs here for Bitcoin. And one of the ETFs that I've mentioned on the platform before is IBIT. That's the iShares Bitcoin Trust. It's up over 2.3%. So for anyone who doesn't have exposure to Bitcoin directly or doesn't want exposure to Bitcoin directly, IBIT is one of those ETFs that you can take advantage of. From its lows of back in August, this is up over 34% as well. If you compare that to how Bitcoin was doing back in September, it's up 34% exactly. So there's pretty good exposure that you can get on something like IBIT. It's an iShares Bitcoin Trust ETF. Of course, very liquid, almost $27 billion in assets under management. I think the expense ratio might also be pretty reasonable compared to some of the other products out there. So Jimmy, are you seeing Tesla hitting a top in the 270s? And if so, would there be a tracement level B to go higher, or would that be to race? What is that word there? Level to be go higher in the 300. So yeah, so for Tesla, we talked about a huge resistance there in the 270s. We got rejected there yesterday. It's not a surprise. That's the level that we were talking about for quite some time. Real question is, of course, whether that supply gets absorbed or not, because we have a lot of resistance here in the red rectangle that I've marked out on the chart for many, many weeks, many months now. And so it's kind of hard to really predict whether we're going to see a breakout or not. I remain optimistic. Earnings were pretty strong. Tesla's pretty much done for the year, I guess, because they don't report until January of 25 now. So, between now and until then, I think election's probably one of the bigger catalysts for Tesla. And other than that, I think there might be some other events, conferences, things like that. But, there's not really any other catalyst that can drive Tesla stock higher. So if there's momentum, builds up, around the cyber cap affordable models, then yes, 270 breakout is possible. But without volume, I don't think it's going anywhere between now and until the end of the year. But again, we'll find out. We'll see what happens over the next couple months here. SoFi still up almost 6%. Very nice move. Very nice breakout. PayPal is still down over 2%. So a little bit over 2%. Pre-market, of course, we saw so much volatility for PayPal here. I mean, just take a look at this massive drop. I was kind of shocked to see like a 14% drop getting bought up so quickly. Literally, whoever plays that trade here at $73 made 16% in a span of like 13 minutes. 16% in 13 minutes. That's over 1% per minute. It's insane how quickly this got bought up back up to $85. And then, of course, selling it down to $81, $82. That's going to be that support for PayPal. So that's what we have. I mean, incredible amounts of volatility for PayPal here. And SoFi pushing up over 6% as expected, because of a very, very strong report. Now, if we were to do any type of, let's say, analysis on these companies, let's say SoFi, for example, full year 2024 revenues between 2.5 and 2.55 billion. They've got shares outstanding. Let's come over here to the income statement. Let's see. You can also look at it on our platform, but if you scroll down, trying to find the income statement here. There we go. So, you've got interest income 2024 671 million, cost of operations, again all that, earnings per share, we got 6 cents. Basic and then diluted, of course, 5 cents. Shares outstanding about 1.1 billion shares outstanding. So, if we are taking them on the high guidance here, let's say 2.55 billion divided by 1104, then we're looking at a net income or GAAP bottom line profitability of 230 million, which is also something that they, I think, guided for at the very top. Scroll down a little bit. I think it was like 200 or 203 million something dollars. Let me just see if I can pull up. I think it might have been on the presentation here. Just give me 1 second. There we go. I can pull that up. Scroll all the way at the bottom. And we get their guidance. There we go. So, okay. So, GAAP net income of $204 to $206 million, right? So, if you really consider what kind of margins they are, so 205 million on the mid guidance, divide that by the revenue of 2.55, we're looking at net margin of about 8% net margins. And if we simply take this number right here, $206 million, and plug that in for SoFi's, analysis of discounted earnings. So if you take that in, apply 205 million, that's kind of like on the mid guidance there. Analyze for 5 years out, plug in a growth rate, which is the most important piece of the entire puzzle because, if you take a look at analyst estimates, analysts themselves are pricing in a growth rate which is very, very significant, from 11 cents to 27 cents in 2025. So in other words, more than doubling, 154% growth in SoFi's bottom line EPS. Then almost a 90% growth in 2026 to 51 cents, 63 cents, 85 cents, and then beating up to $1 per share, increasing 22% year on year. So if we simply do some very simple calculations, what I'm going to do is I'm going to open up a brand new spreadsheet. So just trying to calculate the CAGR. And the reason why the platform is not able to do that right now is because we're coming off of a negative number. So you can see on year-over-year growth, it's showing us negative 129 because this right here is a negative 36 cents. Last year, SoFi was not profitable. This year, it's 11 cents. So we're not able to calculate the CAGR. So we should be able to fix that on the platform. But for now, let's just do 2024. We got 11 cents. And then 2029, we got $1.04. So now if you try to calculate what's that compounded annual growth rate, simply do 2029 minus 2024. That's 5 years right there. Zero payment. We got present value sitting at 11 cents. Future value $1.04. We got a growth rate of 57%. Now, how many people here in the chat? We got over 200 people watching. How many people here believe SoFi is going to be able to achieve over a 56% growth rate over the next 5 years? This is a 5-year CAGR for SoFi. So this is the EPS for 2024. Now, how many people believe that next 5 years, SoFi is going to grow earnings per share every single year by 56%? That's a pretty high growth rate. And it's possible. Look, it's definitely possible if revenues continue to grow 20-30%. And there's just a little bit of margin expansion for the company. It's definitely possible, because we're talking, $1.04. And you take this number, multiply by, let's say, 1,100. That's $1.1 billion in net income. And if you come over to the expectations here for revenue by 2029 is $4.9 billion. So we got $4.9 billion of revenue expectations. So we plug that number in, 4900. So $4.9 billion of revenue, $1.1 billion of net income, and that's a margin of about 23%. So really what analysts are telling us, and this is contingent on what fact? What exactly here? This is contingent on what? So I'll explain here. Revenue, $4.9 billion. That's the expectation out to 2029. Net income at $1.1 billion based on the earnings per share of $1.04. That's a net margin of 23%, right? That's a significant expansion to what the company just reported. They reported about an 8% net margin. So 8% to 23%, that's a 3x increase in net margin, contingent on the very fact that they do not issue more shares. They keep them stagnant at 1.1 billion. If they buy back, that's even better. But it's contingent on the fact that they do not dilute shares at all. Kevin says, so far to the moon. So you and me, Kevin, yes, absolutely. So I, of course, have a very small position as well. But let's just do some calculation. And again, I want to ask everyone, how many people here believe that SoFi is going to be able to grow their earnings per share by 56% over the next 5 years? 56%. That's a pretty high growth rate. I want you guys to think long and hard before you answer. Wow, it's kind of giving up on some of those gains here are starting to drop off. 3.4%, still higher, just a little bit over 1150 right now. But again, let's just do some analysis, right? Let's just let the numbers talk for us. So 11 cents is the expectations right now, and based on where it's trading right now at 1150, you simply take that, and it's right now trading at 104 times earnings on 2024 basis. So that's the PE multiple. Just gonna update that really quickly. That's the PE multiple right now for SoFi at the moment, right? So 105 times earnings based on 2024. 2029 expectations are $4. That of course brings the PE multiple down to about 11, right? That's a lot of expansion there. That's pretty much 10x in earnings per share, but that's also happening on the back of 56% growth for the company. Okay, so let's just plug in a little bit less of a number, right? We don't have to go in that crazy by 56%, but even if we, let's say, plug in a somewhat of a reasonable number at 205 million net income, 5 years growth, let's just start with 30% growth over the next 5 years, giving them a multiple of, let's say, 30, because right now it's trading at 105, right? 105 based on 2024. 12% discount rate, 10% margin of safety. The last 5 years, the share dilution's been 3.5%. If you hit calculate, we arrive at a fair value of 921. It's actually not bad at all, right? A lot of you must have thought that the fair value is going to come in like super crazy, like down in the $2 or $3. It's not bad. And you see how profitably, how important that is. Like, it is so important for a company to be profitable. And just at $205 million, growing at less than what the analysts are expecting at 30%, and giving them a very reasonable 30 times multiple as a fintech company. Again, you can make a case. It's like going to be very similar to Tesla. Whether it's a tech company or if it's a bank, it's mostly a tech company. You got a 30 times multiple, 12% growth rate, 10% margin of safety, and a 3.5% share dilution. And you arrive at a stock that is only 17% overvalued, 921 being the fair value. Of course, you can take a look at the sensitivity grid and you can see, okay, what needs to change in order for SoFi to be fairly valued today. And since right now it's trading at 1150, right? So 1150 right now, you come down, you kind of go across a little bit. There we go, 1143. That means 32 times growth and a 34% growth rate. So if you're asking yourself, is SoFi a buying opportunity today at $11.50? You can make a case for, yes, it is. At trading at 32 times forward earnings multiple and a 34% growth rate. If SoFi doesn't justify that 34% growth rate, analysts are pricing over 57%. If you believe that it's going to be lower, then of course you can take a look at this and figure out, okay, where is it a better buying opportunity? Where is it a good buying opportunity? So that's why this exercise is so helpful, because it kind of really helps you understand all the numbers, right? Everything, the revenue, the margins, the earnings, the share dilution, the growth rates, the multiples, the discount rate, everything, right? Gives you a future target price of $18. And of course, a fair value of $9. So that's the SoFi analysis. Let me know what you guys think. I think a 30% growth rate is reasonable. At the same time, it's high, but also reasonable considering the expectations moving forward. And of course, 30 times multiple is also, I would say, for a fintech company, kind of aligned with that growth rate is reasonable. Now, look what happens if the company doesn't dilute shareholders at all. If there's no share dilution, and if you hit calculate now we're looking at 1094, a little bit under $11. So you can see how much of a difference share dilution makes to companies and their fair values. So $11 would end up being the intrinsic value if there's little to no dilution. But if we still go with the averages here of 3.5% or so minus 3.5 there, and give them slightly a lower growth rate of 25 and a multiple of 25. If we hit calculate now we're looking at a 43% overvaluation at 631. So really, it's just a component of growth rates, the multiples, and the share dilution, and where you're comfortable picking shares up. So for me, 631, 650 would be like a heavy buy target. It would be like a place where you can really start to go crazy, back up the truck and load up. But anything like in the sub 10s would also not make for a terrible risk reward, because the growth rates are well within reason for SoFi, right? 30%, 30 times multiple with a 3.5% dilution, would be well within reason, in my opinion. So I think it needs to close below $12 on Friday. Otherwise, we're rolling. Yes. Well, my call strikes are $15 to $16. So I've got way up there. I think Kevin's also are $15 expiring in December. So it's fine. Going to be down a little bit on those, but it's still way out of the money right now. I mean, for SoFi to get to $15, it has to go up like 40% or something. 15 to 16, yeah, 38 to 40% is how much it would need to go up. And of course, the underlying position would be up quite a bit. So not worried about those. PayPal, on the other hand, there we go. So it continues to accelerate to the downside, and we're down about 6%. We do have some economic data coming out later today, so let's not take our eyes off of that, because if we come over to the market calendar, from an economic calendar standpoint, we do have the JOLTS numbers scheduled for later today, estimates at just under 8 million job openings in the US. So that is also going to be very, very important for the market. That comes out at 10 a.m., so we have plenty of time. But yes, we've got the earnings call starting in 18 minutes. And let's just do the poll here. And let's just ask everybody, which earnings call are they going to be most interested in? Which earnings call are we listening to? SoFi or PayPal? So I'll let you guys decide. Again, so I'm not the bad guy taking away from the earnings call of PayPal or SoFi. So I'll let you guys decide which one you want to listen to. And my guess is there's going to be a lot of majority for SoFi here. But yeah, so let me know which earnings call you guys want to listen to. And if it's like a very close vote, if it's like a 60-40, no, not a 60-40, but if it's like within 50%, like anywhere between 50 and 60%, then I end up making the final decision. Because then it'll be like very, very split vote, and I really don't want to piss off half the people there. Unless it's like a pure majority that everybody wants to listen to one specific stock, then yes, of course, we're going to be doing that. So yes, do participate on the poll. Which earnings call are we listening to together at 8 a.m. Eastern? There's only one that we can listen to, PayPal or SoFi. Let me just double check and make sure that they are indeed happening at the same time, because if they're not, we might not even need this poll. Let's see, PayPal earnings call. Okay, so yes, it says October 29th, 8 a.m. Eastern. That's when it says upcoming events. And let's just see earnings call for SoFi. It also says 8 a.m. Eastern here. Let me just double check on here. And it doesn't say the time. That's the weird part. Let me just go to webcast. And when I add to my calendar, it added it for 8 a.m. Eastern. So I'm assuming it is going to be for 8 a.m. Eastern. Yes, AMD is going to be after hours. Again, it doesn't say anything over here either. So I think last time I checked on the Google Calendar, it was at 8 a.m. Eastern, and then PayPal is also 8 a.m. Eastern. So yes, I think they're both going to happen at the same time there. Folks, do me a favor, share this live stream with everyone. Other people who may want to join us, listen to the earnings call together. We've already broken down the expectations here. So, all in all, pretty good numbers, revising the guidance to the upside. So, %65%, man, PayPal. I didn't expect PayPal to have that many votes for the earnings call there. Yes, AMD is going to be after hours. And I think there's a lot of companies after hours. Google is also reporting after hours. And then we've got Visa, Advanced Micro Devices. All these companies are scheduled for after hours. So there we go. We got SoFi on our platform here. $689 million of revenue, 5 cents in earnings per share, double beat. Come up a little bit. We had a few more companies report. So yeah, Cisco coming out apparently pre-market there. And then of course we got PayPal all the way here. Miss on revenue, beat on EPS $1.20. American Towers miss on revenue $2.5 billion, EPS $2.64. Pfizer coming in $17.7 billion revenue, beat on EPS and revenue $1.06 per share. McDonald's coming in with a double miss there. How is McDonald's doing here? Also down over 2.3% at the moment. $6.8 billion in revenue, $3.23 in earnings per share. So we've got Google, Visa, AMD reporting after hours, which are going to be some of the most important ones. And tomorrow, of course, we've got, and then Chipotle also scheduled for later today. So 4 very important companies. And Snapchat. There was a time in the market where Snapchat had the ability to take down the entire market. Crazy, crazy times. I remember Snapchat, every earnings was like 19-20% down. Reddit is also coming out later today. So after the bell, we got Reddit, Snapchat, Chipotle, Google, AMD, and Visa. So those are the 5-6 big ones. And then tomorrow, I've got even bigger earnings. Microsoft, Apple, Amazon, Meta, tomorrow and Thursday combined, these 4 days. Basically, the next 3 days are very, very critical for the market because this entire block here is just packed. Okay, 65% votes right now. We're listening to Sofi earnings call apparently. So let's take a look here. Sofi is down up still 3%. Okay, so it looks like they've already started the live stream. There's some music playing. As soon as they start talking, I will do a bit of an audio check, and then we should be all set. Folks, do me a favor, drop a like, subscribe if you haven't already. I would really appreciate that. Helps out the channel in a great way. And also share the link, copy the link, and share it with your friends, family, other traders, investors that might be interested in listening in to the earnings calls. Got about 11 minutes left. 11 minutes left for the earnings to begin, earnings call to start. So I know personally you want PayPal. I'm sure you're holding lots of PayPal right now. Yes, PayPal is actually one of the only stocks that I'm currently down on. Literally the only stock that I'm down on my portfolio. That's it. I think that loss has also been shrunk down to like 16% or something. I remember being down like 50% at one point on PayPal. But honestly, like I don't mind listening to Sofi because Sofi has been a recent position. It's been a buy right, picked up quite a few shares, of course, not at the same level as, some of the other people there, but it's still a reasonable position. And so if Sofi can, double up from here, I might be able to make up all the losses from PayPal. So it's really, it's really not a big deal. I'm happy with both of them. My vote may just go to Sofi because I think that might be a little bit more of an interesting call. PayPal, we're already kind of aware of their business for the most part and where the focus is. But I think it's going to be a bit more challenging for Alex Chris to kind of navigate this environment, the competitive fintech environment that we're in. But he seems to be doing a pretty good job. I mean, the growth in active engagement, the growth in active accounts, PayPal investors kind of desperately wanted to see that for a very long time as 2 consecutive quarters of active accounts growing. And we really need to cross over 435 million in order to hit a new all-time high. I think that's going to be a pretty big deal with record active accounts and record engagement. I think the biggest problem with PayPal this quarter was the take rate coming down 4 basis points and really declining with the margins there. So that could be one of the reasons why it's coming down. But the guidance overall was still pretty strong. And if you run kind of a very similar analysis on PayPal, because if you come over to, let's just come over to the guidance from PayPal there. So let's see, that's a third quarter 2024 snapshot. Scroll down a little bit, guidance-wise. They're looking at GAAP EPS of 392 to 396, non-GAAP in the high teens, free cash flow approximately $6 billion, right? $6 billion of free cash flow. And if you run a discounted cash flow model on PayPal, so let's just come over to their platform and we do a DCF on Analyzer, discounted cash flow. If you plug in, let's say $6 billion of free cash flow for 5 years, growing them at, modest 12%, same amount of share buyback and everything, we get a stock that's still undervalued, right? Even at a 12% growth rate on $6 billion of free cash flow. It's not until it comes down to 8% growth rate that it is fairly valued. In fact, pre-market, since it's down to $77, will have to come down to 6% for it to be 74. Yeah, just for it to be like somewhere close to where it's trading pre-market. So what this basically means is PayPal only needs to grow free cash flow by 6% over the next 5 years, and keep buying back the same amount of shares by about a 1.6% every single year. And then, even then, it's going to be trading at a fair value, which is $74, $77. Now, of course, if PayPal can grow more than 6%, which ideally would be the more optimistic and more realistic assumption, if you go with, let's say, 10% in growth rate, then you see the stock, of course, becomes undervalued with a fair value sitting at $87. If you go with 12%, then even better. $94 ends up being the fair value, down almost 13% and undervalued. And of course, the higher you go, the better the numbers become, undervalued by 22%, sitting at $102 in fair value. So I think 6% is quite crazy low for PayPal's growth rate when they're guiding for $6 billion in free cash flow, and they can easily increase those cash flows from $6 billion to well over $8 billion in the next 5 years. So that's the simple discounted cash flow model. If you want to come over to the earnings multiples here, I think the expectation for net income, by the way, we're going to be starting the call here very soon. And I'll switch over to the audio to make sure that everything is working well. But let's see, we got non-GAAP EPS or GAAP EPS between 392, 396. And 392, 396 there. I'm just going to have to go up a little bit, pick up the revenue number, 7.8 billion. Love your charts. Thank you so much. I appreciate that. And yes, you can kind of do a lot of this analysis yourself. Like, one of the reasons why we've built this platform is so you can plug and play. It's like completely come in, autofill, plug in your own analysis. You can even go with the case analysis on PayPal. You can do a bear case, base case, bull case. What if margins come down? What if margins expand? What happens if multiples are up or down? What happens at different growth rates? Like, you can do a lot of different things here, and it's going to spit out a lot of these values for you, all pre-calculated. All you have to do is just plug in your own inputs in these boxes. So that's why it's been so useful to kind of really figure out, okay, what's the actual price? Even if it's not super exact, even if it's like not to the T, because it's never going to be super accurate, gives you a bit of an idea. It gives you a sense of, based on earnings, based on revenue, based on multiples, based on growth rates, what can you expect from the future in terms of prices. So if we come over to the numbers here, so there we go, non-GAAP EPS high teens growth here, 392, 396. And now I just need the shares outstanding there for the company for this most recent quarter. Come down and gonna see that's that balance sheet. There we go, income statement. We got diluted shares at just over 1 billion. Okay, so 396 multiplied by 1024, we're looking at just over $4 billion in net income. Just over $4 billion of net income from the company. So we're going to come here, 4055. And growth rate, right? That's the interesting piece, because growth rate is coming down. Yes, it's still at 19 to 22%, so that's very strong. But if you come over to analyst estimates, analysts are expecting 452 in 2024. This is, by the way, on a non-GAAP basis, growing all the way up to $8.25. So you can see that CAGR, that's the compounded annual growth rate, has come down significantly, right? It's come down from 17% down to 13%. So the next 5 years, growth rates are going to come down for PayPal. And that's one of the reasons why, many people argue that it's no longer a growth stock. It's really coming down to a more of a value stock because of the drop off in the growth rates. So if you do that, 4055, let's say plug in a 14% growth rate trading at, let's say 25 times P multiple, same amount of share buybacks and all that stuff. Look at that, right? Still undervalued. $105 in fair value at 26% undervalued. If you go with a lower multiple, because the growth rates are coming down 20 times, because if you take into account where PayPal is trading right now, $78, and the earnings per share expectations are sitting at 392 and 396, somewhere between those numbers here. Let me just come back here. There we go. So 392 and 396. So you do the math, right? Let's just take mid guidance of 395. 395 earnings per share on a GAAP basis. Stock's trading at 78. 78 divided by 395, we're looking at a P multiple of 19.7. So right now it's trading at 19.7 times earnings of 2024. PayPal, that's where it is based on the pre-market move. So if you go with 20 times P multiple, if you hit calculate now, still undervalued. And the fact that it's lower pre-market by 6%, it's going to be undervalued more based on a 14% growth rate of earnings and 20 times P multiple, same amount of share buybacks. Now you can see the sensitivity grid yourself. Let's say the growth rate's not at 14%, it comes down even more at 12%. Then the fair value is at 77. If it's at 10% growth rate, then the fair value is at 70 at 20 times P multiple. But if you want to come down on the multiple and down on the growth rate, let's say 10% growth rate and 18 times P multiple, the fair value drops to $63. So that's why, like I said, it's useful to have an understanding mathematically what makes sense, where it's been trading at and where it could be trading at. Juan says PayPal equals value trap. It could be because look, the growth rate is really what's going to drive the stock. So that is where the expectations come from. And when growth rates come down, even if this is a company that's growing on an absolute basis, it could still perform really poorly because the growth rate is not as high as it used to be. In SoFi's case, it's the exact opposite, right? Growth rates well in the 50%, 57% from analysts, which is, again, insane. And as a result, it's doing much better compared to PayPal, right? Still up 3% pre-market. And of course, PayPal here is down 6.6. Okay, so the earnings call should be starting here. We're going to go with SoFi, I guess, because we got 67% votes on SoFi. So I'm going to end the poll there. We're going to listen into SoFi's earnings. And that's about it. I think that should do it. For the earnings, we've calculated the fair value roughly for both of these companies. Spent a lot of time on the earnings breakdown. So I think that should pretty much cover it. And now we'll listen in to the earnings call from SoFi, which should start in about a couple minutes here. And then of course, take a look at the price action for both. We can take a look at the price action for both. So I'll keep PayPal here on the 5-minute chart. Still down 6.5%. And then, of course, SoFi over here, up over 3.3% on the 5-minute chart here. Yeah, I believe SoFi is a better buy just based on its room to run up, and the CEO is great. And that's the thing, like with every growth stock, there's going to be room to run because the growth rates are much higher. Everybody wants to invest high growth rates, high margin businesses. That's why NVIDIA has done so well because the margins have expanded, the growth rates have been so strong. Nobody wants to be an investor in of course, margins that are compressing and growth rates that are coming down. Even though on an absolute basis, growth rates are still strong, like 17%, 16%, 14% is still pretty good, but it's not as good as what it used to be, right? So it's all relative. And that's what kind of market is so interesting is because on a short-term basis, everything is relative. I remember when Upstart was doing so well because the growth rates were so high, then they started to drop off, right? Went from 100% growth rate down to 80%, then 60%, then 40%, and then all of a sudden negative growth rates. And then the stock just absolutely got demolished, as the quarter started to come out. So it is all about the growth rates and the margins. And, SoFi, of course, with 50% growth expected over the next 5 years, clearly is going to be the stock, one of the hotter stocks. And PayPal here, since the growth rates is still strong, but it's still not as strong as what it used to be, and it's coming down. It's not It's not doing well. It has done well though. Like, I got to give credit to PayPal because ever since Alex Chris has taken over, the stock is up 30 to 40%. So it's not like it's, one of the worst performing stocks or it hasn't done well, because you can see that, in the last 1 year, the stock's up 62%. Year to date, it's actually outperforming the market up over 36%. So it has done well. So we got to give credit to where credit's due, and PayPal has indeed done well. Of course, this earnings, it's not very well received compared to some of the other ones that we've seen, but you never know. I mean, we'll see what happens during the day. The company still did raise their guidance on the earnings and the revenue, trading at just over 19 times earnings, so not terrible. Okay, so the final verdict is going to be SoFi earnings is what we're going to be listening to, and from a price action standpoint, we will be watching both companies, PayPal on the left, SoFi on the right. And pre-market right now, we got SPY. QQQ is very, very flat at the moment, so not a lot of momentum there. Still waiting on the earnings to start here. So PayPal's already started. SoFi has not yet. So why don't we just listen to PayPal for the time being, and then we'll switch over to SoFi once it starts. Okay?
And innovations and momentum are resonating. Before we discuss this quarter's details, I'm excited to announce that we will host an Investor Day on February 25th in New York City. We look forward to seeing many of you in person and sharing our team's longer-term strategy, key opportunities, financial and operating targets, and how we will get there. Now turning to our Q3 results. Total payment volume grew 9% to $423 billion. We delivered $7.8 billion in revenue, growing 6% on a currency-neutral basis. Transaction margin dollars grew 8% to $3.7 billion, and were up 6%, excluding the benefit of interest on customer balances. Our non-GAAP earnings per share increased 22% year over year. Importantly, this translated into significant free cash flow. We're proud of these results and have a clear plan to drive continued profitable growth over the long term. After another strong quarter, we're raising our full year
members, products, as well as revenue per product in the quarter. We added 756,000 new members in Q3 year to a total of 9.4 million members. We grew products in the quarter by over 1 million to 13.7 million products. That's up 31% year over year, or 37% when excluding digital asset accounts related to our transfer of crypto services in 2023. The financial services segment drove 964,000 of those new products. Importantly, revenue per product was $81, up 52% from a $53 a year ago. We believe there remains substantial upside in both product growth and monetization. Our one-stop shop continues to attract great cross-buying behavior by our members. In fact, 32% of new products were opened by existing SoFi members, and 20% of our new members open a second product in their first 30 days. This is the power of the flywheel we have developed. In our tech platform, we reached over 160 million total accounts. That's up 17% year over year. Overall, we're making incredible progress in our shift towards more fee-based, capital-light, and lower-risk revenue sources. Combined, fee-based revenue made up $174 million, or a quarter of our adjusted net revenue in Q3. This revenue grew by 65% year over year. On an annualized basis, that's nearly $700 million in revenue. This progress was driven by a record quarter in our loan platform business, which totaled $56 million in fee-based revenue and is up more than 5x year over year, as well as strong growth in interchange, which is up 2x year over year. Chris will share more details on these areas in a few moments. On top of all of this work to diversify our revenue base to capital light, high return on equity, and fee-based revenue, we also grew our lending segment in Q3. We seized on the improving rate environment in the quarter, our improving credit trends, and strong performance across all lending products to achieve a record $6.3 billion in loan volume and $392 million in adjusted net revenue, up 14% year over year. Looking back at the progress we've made over the past several years, it's fair to say that SoFi is battle-tested, given the scale, profitability, and growth we have recorded for the total company in 2024, with our largest and most profitable business lending barely growing. It should now be crystal clear that SoFi can drive sustained growth across the cycle. We've achieved 17 of 19 quarters of record revenue through a recession, a pandemic, a 150 basis point rate drop, damage to our largest and most profitable business, student loan refinance, only to face a 500 basis point increase in rates and the collapse of venerable financial institutions in our neighborhood. The innovations we have driven to scale our non-lending revenue, which are capital light and high ROE, have enabled us to grow our total revenue by more than 20% year over year for 17 consecutive quarters, as well as grow both our members and products by 35% or more year over year, excluding digital asset accounts transferred in 2023. Our performance in the hard times is what gives me the strong confidence in our future. Today, we face fewer headwinds than any point in our history. We're heading into 2025 with the most favorable conditions of the last 7 years, with declining rates and a stable economy. With the most diverse business we've ever had, with more members in our ecosystem and more products that serve their needs than ever before. This brings me to my second topic, the innovation and brand building that drive our durable growth. The market for consumer financial services is massive and historically poorly served. A Mintel report found that just this year, 1 in 5 U.S. adults have been in the market for a new savings account. A similar number are looking for new credit cards. Those markets, not to mention those looking for new investment accounts, new checking accounts, new personal loans, new mortgages, and buy now, pay later, all grew year over year. Meeting all of a person's financial needs in one place with world-class products delivered seamlessly and digitally gives us a massive advantage. This is why you will often hear me say, it's a matter of when, not if, we become a top 10 financial institution. To do so, it's absolutely critical that we build the unaided brand awareness to become a trusted household brand name. The awareness we generate for SoFi is highly effective at getting people to try a product. After becoming a member, they cross-buy into another product, then another. They recommend SoFi to others. This flywheel that we've created drives acquisition costs down over time and reliably generates profits that we can invest in new product innovations to serve even more of our members' needs. Our accomplishments in Q3 demonstrate the power of this virtuous cycle. First, we continue to establish SoFi as a trusted household name. We ended Q3 with our highest average unaided brand awareness of all time, up nearly 40% year over year to 7%. Our highly effective marketing engine continues to reach and engage new audiences. For example, Q3 saw the kickoff of the new NFL season at the award-winning SoFi Stadium. We unveiled a new brand campaign with LA Chargers quarterback Justin Herbert, inspiring people to reach their most important financial ambitions. We also launched new partnerships with Los Angeles Sparks forward Cameron Brink and tennis champion Venus Williams. And coming in January, the TGL presented by SoFi, a new tech-infused arena golf league with an exciting match play format across teams of top PGA Tour golfers like Tiger Woods, Rory McIlroy, Wyndham Clark, Xander Schauffele, and Justin Thomas, just to name a few. Second, we continue to innovate so people find unique value when they use our products, starting with our financial services segment. In SoFi Invest, we've seen strong engagement driven by new alternative assets, mutual funds, and money market funds we've rolled out over the past year. Overall, we're providing Main Street investors access to unique investment products historically reserved for the ultra-wealthy, like interval funds, private credit, private real estate, and private venture. We also launched our new directed share program, which offers a modern and streamlined approach to equity programs for companies looking to raise capital through IPOs. And we are expanding our award-winning robo offering later this year. Importantly, we are building the Invest business cost-effectively by appealing to existing members. 70% of signups are existing SoFi members. In SoFi Money, we reached record highs in accounts, total deposits, and direct deposit members. We grew member deposits by nearly $2.4 billion, and annualized debit spend reached $10.3 billion in Q3. We will soon improve our self-serve wire transfers, which, similar to introducing Zelle, will further expand members' money movement options. In our member team, we're beta testing a new Cash Coach product that will analyze members' cash across all of their financial products at SoFi and beyond, and offer various ways to optimize their cash. Whether it's paying down expensive debt, setting up an emergency savings fund, getting more yield on their savings, or making investments in a diversified portfolio that is appropriate for their goals. We're also on track to launch improvements to SoFi Plus, our premium membership tier, and are beta testing a new fee-based subscription option in the coming months. Over time, SoFi Plus will increasingly show the magic of our strategy, deliver incremental and unmatched value across our portfolio of products. In credit cards, we officially launched the Everyday Cash Rewards and the Essential Credit Cards, enabling SoFi to serve more people's spending and borrowing needs, whether it's helping them earn rewards or building their credit. In our loan platform business, what started as a decline monetization funnel has now evolved into an integrated loan platform experience, which now offers just-in-time lending. In Q3, the loan platform business grew 5x year over year, mainly driven by record personal loan volume. We expect this business to continue to grow as we shift towards even more fee-based, capital-light, and lower-risk sources of revenue. We also signed our first 2 direct insurance carriers for SoFi Protect, complementing our comprehensive financial services offering we've built over the last 5 years. Turning to our lending segment. In personal loans, our innovation has helped generate a record $4.9 billion in volume, up 26% year over year, including $1 billion originated on behalf of third parties for our loan platform business. In home loans, we grew total home loan volume 38% year over year to $490 million. Home equity loan volume was up 44% from the prior quarter as rates began to decline. Home purchase and refinancing volumes grew 23% from the prior year period. In fact, home refinancing volume was the highest we've seen since the second quarter of 2022. And finally, in our tech platform, we signed several new partnerships, including processing deals with 2 charter banks in Mexico and a deployment of Galileo's Cyberbank Core for SoFi's new commercial payment services sponsor bank program. We launched additional fraud prevention solutions, the Galileo Instant Verification Engine, which we call GIVE, as well as Transaction Risk G-Score, both of which help clients enhance their security and operational efficiency. Our new secured credit with dynamic funding offering promotes greater financial inclusion and enables clients to help their customers build stronger credit. And lastly, we launched programs with clients signed in prior quarters spanning cross-border payments, global payouts, financial literacy, and scalable payment solutions. On top of this relentless focus on innovation and brand building, we built our business to deliver strong and reliable returns well into the future. We achieved record profitability in Q3. GAAP net income reached nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year. EBITDA grew 90% from the prior year to a record of $186 million. All 3 of our operating segments achieved record contribution profit in the quarter. We continue to improve credit performance in Q3 and are firmly within the life of loan guidance we've previously provided. As we've shared in our last call, delinquencies peaked in March of 2024. Since then, we've continued to see improvements quarter over quarter. Cumulative fair value adjustments, along with delinquencies on an absolute and percentage basis, all performed better in Q3. With all the innovations we've made across marketing, originations, and servicing, buyers continue to see compelling opportunities in SoFi's loan portfolio. Loan sales reached almost $1.3 billion in total this quarter, and nearly $5 billion in the last 12 months. And finally, with our strong balance sheet, we are well capitalized heading into an improving rate environment. Our total capital ratio is 16.3%, well above regulatory minimums. In Q3, tangible book value increased $236 million to a total of $4.4 billion. We look forward to building on this momentum and delivering continued returns heading into the new year. In closing, I couldn't be more proud of what we've accomplished, not just for Q3, but for delivering a steady and consistent record of durable growth, incredible brand building and product innovation that help our members and clients, and strong improving returns for our shareholders. The future is bright, and I am fired up for what's in store. With that, I'll hand it over to Chris.
Thanks, Anthony. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2024 versus the third quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. The record results we achieved across all three segments this quarter are a testament of our continued execution, our durable growth in members, products, and clients, and our diversification toward capital-light, fee-based revenue with increased returns. For the quarter, we delivered record adjusted net revenue of $689 million, with growth accelerating to 30% year over year, up from 22% last quarter. Adjusted EBITDA was $186 million at a 27% margin. This represents nearly 9 points of year-over-year margin improvement, demonstrating significant operating leverage across all of our functions, with expense margins decreasing year over year. Importantly, sales and marketing continues to decline as a percentage of adjusted net revenue, decreasing by 4 points year over year. We delivered our fourth consecutive quarter of GAAP profitability, with GAAP net income reaching nearly $61 million, a $327 million improvement year over year, or $80 million when excluding the goodwill impairment expense we incurred in the prior year period. We generated GAAP EPS at 5 cents per share in the quarter. On a trailing 12-month basis, we delivered $214 million of GAAP net income, and when looking at the sum of our reported EPS over the past 4 quarters, we generated about 11 cents per share. Now on to the segment level performance, where we saw record revenue and contribution profit across all 3 operating segments. Starting with financial services, we achieved $238 million in net revenue, up more than 2x year over year. We reached nearly 11.8 million products in the quarter, up 33% year over year, or 40% when excluding crypto accounts. We continue to improve monetization across all products, with annualized revenue per product of $81, up 52% year over year versus $53 in the prior year quarter. This growth was driven by higher deposits and member spending in SoFi Money and significant expansion of our loan platform business, which I'll describe in a moment. Both of these businesses achieved all-time records for revenue in Q3. We also benefited from new monetizable features in SoFi Invest and saw robust growth in credit card spend. We see significant opportunity for growth in these businesses, as well as SMB and Protect, which are all under monetized today. Net interest income of $154 million increased 66% year over year, which was primarily driven by growth in consumer deposits. Non-interest income grew 235% to $84 million in the quarter, which represents nearly $340 million in annualized revenue. The key driver of non-interest income growth this quarter was our loan platform business, where we refer pre-qualified borrowers to origination partners and originate loans on behalf of third parties. Here's how our loan platform business works. With our best-in-class product, highly effective marketing engine, and network of respected buyers like Fortress, with whom we announced a $2 billion loan platform business agreement earlier this month, we can efficiently match the demand of members shopping for loans with the demand for high-quality loans in the capital markets. When a member takes out a loan, they gain all of the benefits of becoming a SoFi member, along with easy access to other products in our one-stop shop, even though we originated the loan on someone else's behalf. This enables SoFi to serve more potential members while also further diversifying toward less capital-intensive and more fee-based sources of revenue. In Q3, we generated $56 million in loan platform fees, driven by $1 billion of personal loans originated on behalf of third parties, as well as referrals. We also generated $5.5 million in servicing cash flows, which is recorded in our lending segment. Our loan platform business in total added $61 million to our adjusted net revenue. In addition to our loan platform revenue, we continue to see healthy growth in interchange, up 211% year over year, as a result of $12 billion in total annualized spend in the quarter across money and credit card. Overall, contribution profit for our financial services segment in the quarter was a record at nearly $100 million at a 42% margin, even as we continue to invest in innovation, acquisition costs that require a payback period, and new opportunities to rapidly grow this operating segment with attractive returns. Shifting to our tech platform segment, where we delivered record net revenue of nearly $103 million in the quarter, up 14% year over year and 7% sequentially. Revenue growth was driven by strong contribution from new clients, as well as growth in Latin America, consumer brands in the U.S., and clients with innovative use cases like earned wage access and money movement. Galileo accounts grew 17% year over year to $160 million. The segment delivered a record contribution profit of $33 million, representing a 32% margin. We've discussed before how the pipeline spans banks, brands, and fintechs across consumer and B2B, which offer larger and more durable revenue. The pipeline is in a stronger spot than it's ever been, and the investments made in this segment have greatly expanded the market opportunity. Recent wins and pipeline strength are early, but telling signs that the strategy is working. Moving on to lending, we achieved record adjusted net revenue of $392 million, with a record of $239 million of contribution profit at a 61% adjusted margin. These results were driven by 19% year-over-year growth in net interest income, while adjusted non-interest income decreased by 2% year-over-year. Growth in net interest income was driven by a 35% year-over-year increase in average interest earning assets, slightly offset by a 44 basis point year-over-year decrease in average yields. This resulted in an average net interest margin of 5.6% for the quarter. In terms of non-interest income, Q3 originations grew 23% year-over-year to over $6.3 billion and were driven by a record quarter in personal loan originations, which grew 26% year-over-year and 17% sequentially to $4.9 billion, with $1 billion originated on behalf of third parties for our loan platform business. Our student loans business saw origination volume grow 3% year-over-year and 28% sequentially to $944 million, our best quarter since Q1 2022. Home loans volume grew by 38% year-over-year and 17% sequentially to $490 million, our best quarter since 2021. In the third quarter, we sold portions of our personal loan, home loan, and senior secured loan portfolios totaling $1.3 billion. In terms of personal loan sales, we closed approximately $375 million of loans in whole loan form at an execution of 105.9%. These had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $504 million of home loan sales were sold at a blended execution of 102.6%. Additionally, we sold $81 million of late-stage delinquent personal loans in the quarter. As we've noted in the past, we typically have not sold delinquent loans until such a time that they are charged off. However, we have been able to generate positive incremental value over time in these sales relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we sold $312 million of senior secured loans at a par execution. In addition, one of our large senior secured loans with $594 million of principal outstanding was prepaid and refinanced by the borrower and is no longer on the balance sheet. Net-net, inclusive of new issuance in period, our secured loan balance decreased by more than $750 million sequentially. These transactions demonstrate clear market support for the marks on these loans, with $312 million of our senior secured loans sold at our marked value and another $594 million of senior secured loans prepaid so the borrower could refinance with another bank at more attractive rates. Turning to the profile of our borrower and the overall credit performance. Our personal loan borrower's weighted average income is $164,000 with a weighted average FICO score of 746. Our student loan borrower's weighted average income is $135,000 with a weighted average FICO score of 765. After seeing credit trends peak in Q1, we have seen continued improvement in personal loans. Our on-balance sheet 90-day personal loan delinquency rate was 57 basis points in the quarter, a decrease from 64 basis points in Q2, which is further evidence of surpassing a peak in Q1. Our personal loan annualized charge-off rate decreased to 3.52% from 3.84% in Q2, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 5.0% versus 5.4% last quarter. For our student loans, our on-balance sheet 90-day delinquency rate remained flat quarter over quarter at 12 basis points, while our annualized charge-off rate was 69 basis points. The data continues to support our 7 to 8% maximum life of loan loss assumptions for personal loans in line with our underwriting tolerance. Similar to last quarter, we've provided a loan vintage analysis on page 10 of our investor presentation. Since this only provides a partial window into our loan portfolio, we're unlikely to provide this same analysis longer term. However, it's a helpful illustration of how recent vintages are collectively performing against our 2017 vintage, as this is the last time that we approached 8% life of loan losses at 7.85%. You can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 to Q4 2023 vintages, soon after we made material cuts to credit, net cumulative losses of 3.3% are well below the 4.8% observed in the 2017 vintage at the same point of 49% remaining principal balance. The gap between the newer cohort curve and the 2017 cohort curve widened slightly quarter over quarter. Furthermore, looking at page 11 in the investor presentation, you will notice that only 43% of unpaid principal balance remains from our Q1 2020 through Q2 2024 originations. Among the 57% of principal that has already been paid down, we've seen 6% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of more than 10%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at a 105.7%, 142 basis points higher quarter over quarter. This was driven by a 97 basis point decrease in the discount rate to 4.78%, which was directly driven by the drop in benchmark rates by 113 basis points and offset by 16 basis points of spread widening. The constant default rate, or CDR, also decreased by 28 basis points, which is consistent with the observed credit trends I just highlighted. For our student loan portfolio, the fair value mark increased by 183 basis points to 105.4%. This was driven by a 45 basis point decrease in the discount rate to 3.99% due to an 87 basis point decrease in rates, but offset by 42 basis points of spread widening. The weighted average coupon on the portfolio also increased by 17 basis points. The fair value gains in the quarter were significantly more than offset by our hedge losses and the negative impact from spreads widening. Net-net, we did not see a positive impact on the reported revenue from the change in marks, net of hedge losses and new originations. Switching to our balance sheet, where we remain very well capitalized. Assets grew by $1.7 billion as a result of nearly $1.4 billion growth in loans and approximately $226 million of an increase in cash equivalents, and investment securities. On the liability side, member deposits grew by nearly $2.4 billion to nearly $23 billion, while overall deposits increased to $24 billion. We reduced our broker deposits by $445 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack. Currently, there's a 220 basis points difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to more than $500 million in annualized interest expense savings given the size of our deposit base. We exited the quarter with just $1.3 billion of warehouse debt drawn. This difference continues to support our net interest margin of 5.6%, underscoring the benefits of having the option of holding loans on balance sheet when advantageous in collecting net interest income. We continue to expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix shift towards deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.3% remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $6.1 billion and tangible book value by $236 million sequentially to $4.4 billion, with tangible book value per share at $4. Now on to guidance. For the full year 2024, we now expect to deliver adjusted net revenue of $2.535 to $2.550 billion, which is $85 million higher than our prior guidance range of $2.425 to $2.465 billion. This implies 22 to 23% annual growth versus 17 to 19% previously. This guidance assumes lending revenue will be at least 100% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow low to upper teens % year over year. We now expect to deliver adjusted EBITDA of $640 to $645 million, above our prior guidance of $605 to $615 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $204 to $206 million, above prior guidance of $175 to $185 million, and GAAP EPS of 11 to 12 cents per share, above prior guidance of 9 to 10 cents per share. We now expect growth in tangible book value of approximately $1 to $1.05 billion and continue to expect to end the year with a total capital ratio at or above 16%. In terms of member growth, we expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q3 results. We continue to demonstrate our position as a durable growth story, which is reflected in this quarter's strong results. Despite operating in unpredictable macro conditions, we've maintained a clear focus on executing our strategy, driving returns, and helping our members get their money right. We could not be more excited about the opportunities ahead of us as we continue our journey towards becoming a top financial institution. With that, let's begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll only take one question per person at a time. Please rejoin the queue for any additional questions. And our first question today comes from Dan Dolev from Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great results as always. Can you give us some more color on the loan platform deals? Like, how do you make money here, and how does this differ from the prior quarters? Thanks again, great results.
Sure, thanks, Dan. So overall, this is a great fee-based and capital-light revenue source for us. We're not taking balance sheet risk. We're generating meaningful cash fees upfront at time of transfer or referral, and we're able to serve the needs of more members at a more rapid pace than we've been able to do so before. So there are several ways that we make revenue within the business, which has certainly evolved since we started focusing on decline monetization in 2019. First is we send qualified borrowers to platform partners via our Lantern marketplace, and we receive a referral fee if the borrower takes out a loan. The second way we make money is we can embed the specific credit box of our platform partners into our underwriting engine and originate on behalf of those partners, with the transfer of those loans to the partner occurring shortly after origination. For that, we receive an upfront cash fee, and we also retain servicing. The third way, and what's new this quarter, is that we're able to originate on behalf of other third-party investors based on a specific asset characteristic and return profile of that investor, with loans transferred shortly after origination. This is within days or a week. We receive an upfront cash fee, platform fee for that business, and we also retain servicing. And then the fourth way that we can make money, and we've been doing this for a few quarters now, is we can service assets that we do not originate but are held on the balance sheets of other third parties. For that, we receive regular servicing fees that are not capitalized. What I would say is important is in all of these cases, these are assets that we wouldn't have otherwise underwritten unless contracted due to a number of reasons, including first, the credit profile and other characteristics of the assets, which may not be directly consistent with our current portfolio. Second, our own risk appetite may not align with those originations. And then finally, our capital allocation strategy at any given point in time may not align. The last thing I would say here is that there are no financing commitments or loss share agreements associated with any of these deals or partnerships.
And the only other thing I would add, Dan, and this may not be known by a lot of people, but we decline between 70 and 80% of the personal loan applicants to Sofi. And so there's a lot of potential, latent potential there to service them better. And so that's a big number that exists before we even try to do anything else in this business in terms of generating incremental demand or other initiatives to make people aware of the products that we can offer.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hey, thank you. Good morning. So your originations came in ahead of our expectations, and it's increased each quarter of this year. Credit seems to be improving sequentially, and the macro probably a little bit less clear than earlier this year. So I guess going forward, how do you think about originations and lending growth for your own balance sheet versus maybe originating for some of your partnerships?
Yep. What I would say is our overall outlook for originations, or at least growth on the balance sheet, has not changed. We do expect to see modest growth in dollar terms on the balance sheet year over year, and that will continue into Q4. We are happy with the size of the balance sheet that we have today and the amount of net interest income that we're generating. We are seeing excess demand both on the borrower side as well as the loan investor side for our unsecured personal loans, and we've been able to successfully navigate and fulfill that demand through the expansion of our loan platform business. So we would expect not to grow the PL balance sheet meaningfully from where we are today. Where we will migrate into is in a lower rate environment, you would see an uptick in demand for our student loan refinancing business, where we had a really strong quarter this quarter, as well as our home loans business, where we had our best quarter since 2021.
The next question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys. Congratulations, and thanks for taking my question. I appreciate all the information, on the credit side about the 17 vintage versus the more recent ones. It looks like, the current vintages are performing better than the 2017 vintage. I'm wondering, how do you guys think about that, the contribution of that performance trend to like return on capital, and how do prepayments or your just payment assumptions impact this outcome as well?
Yeah, thanks, John. So we often talk about underwriting to an 8% life of loan loss target, which obviously reflects the strength of our underwriting and the high quality of our borrower base. However, life of loan losses represents just one of several variables, which in combination actually drive our pricing and underwriting decisions designed to maximize return on equity while adhering to our credit risk tolerance. In terms of how we think about the returns on recent versus some of our past vintages, all-in returns on our more recent vintages are projected to produce meaningfully higher returns. I'm talking greater than 2x versus 2017, with newer vintages expected to produce ROEs above 30%. And I'm defining ROE here as the weighted average coupon minus annual losses, funding costs, and other operational costs, plus origination fees, and then multiplied by the weighted average life and levered. What's really driving those increases in returns is a function of a number of things. First is lower expected life of loan loss rates, as we show in our investor presentation on page 10. Second is the higher pricing beta throughout rate increase cycles. We've demonstrated time and time again that we've been able to maintain really good betas. We were successful in increasing the portfolio weighted average coupon across both products in a rising rate environment over the course of the last few years. And we've also been able to maintain pricing in down rate environments due to the quality of our product. The third way is we've had funding cost efficiencies given our higher reliance on member deposits and success in growing direct deposits and replacing higher cost warehouse funding. And then fourth, we've introduced origination fees over the course of the last year plus, and we're now generating close to $400 million in origination fees annually. So the combination of these drivers is more than offsetting the increase in prepayment speeds and the reduction in weighted average lives that we're observing in some of these newer cohorts. Going forward, what I would say is we're going to be talking about return metrics more often because these life of loan losses don't provide the full view.
Another thing I would just emphasize, John, and everyone and the shareholders more broadly, is that we've been able to achieve these types of high ROE returns in more recent vintages, despite the fact that rates have been, increased significantly in a very short period of time, and the economy has been somewhat uncertain during that time period. As we look into 2025 and a declining rate environment and a stable economy, we think we can only improve on these returns, and it's one of the reasons why we're leveraging all the different businesses we are across the opportunity set that we have from a return standpoint relative to what we believe is a prudent level of balance sheet risk in a particular asset class such as personal loans. So we think there's a lot of upside and it only gets better from here.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey, good morning. Could you just talk a little bit more about the expectations for the loan platform business, how you expect that can grow from here? I know you've said expect that to continue growing, but how meaningful can this become? It seems like, if we look at the numbers today, it's already at a $4 billion run rate. You've got the Fortress relationship, which, correct me if I'm wrong, is additive to that, so that's already $6 billion. And should we be thinking about the economics as close to a 5.5% take rate based on the revenues you reported this quarter? And then I'm just curious, are you going to maybe de-emphasize the loan sales a little bit more from here? I mean, it came in a little bit lower at the 375 versus the billion for the last 3 quarters as you maybe prioritize the loan platform business from here? Thanks.
Yep. So I'll start, and Anthony can chime in wherever. But in terms of the overall growth expectations, what I would say is as part of that $1 billion of originations that we did, Jeff, in the period, a portion of that did come from the Fortress transaction that we announced earlier in the quarter. So it's not additive to your $4 billion run rate. It's inclusive of that. But we do expect to see continued strong growth in the segment. We have that $2 billion agreement with Fortress, as well as commitments for Q4 and 2025 with several other partners. What I would say is we're one of the very few partners who can deliver assets at scale with the characteristics and return profile that investors are seeking. In terms of de-emphasizing other sales and ABS transactions in favor of this, what I would say is that demand is as strong as it's ever been before. Like I had mentioned a few questions ago, we're happy with the size of the balance sheet and the modest growth that we're expecting over the course of the next 3 months. But what I would say is that we are seeing excess demand both from borrowers and investors, and a way to fulfill that demand is through the LPB business. In terms of the take rate, what I would say is we're looking at apples and oranges when you're trying to compare this take rate to what you see in the general originate to sell business. These are loans that are originated on behalf of others, and they would not have been originated unless contracted to, given the credit and overall asset characteristics of the loans, as well as our own risk appetite and capital allocation strategy. What we're receiving is a platform fee for our underwriting capabilities, our marketing capabilities, and our overall operational capabilities, and that platform fee will vary depending on the partner.
And I think, a couple points just to emphasize. One is the partners in the loan platform business, many of which are new incremental partners on loans, as opposed to the wholesale loan buyers or ABS buyers that we've typically had. They're not all incremental, but a large percentage of them are, including in the most recent quarter. In addition to that, Chris has mentioned a couple times, these are loans that wouldn't have otherwise originated, and we only originate when we actually have a contract. So it's not a zero-sum game, it's incremental, and the outlook for is pretty significant as we go into 2025 in excess of what you articulated.
The only other thing I would say in terms of, you had mentioned $375 million of sales done in period. We did over $1 billion across all three products in the quarter, and $6 billion over the course of the last 12 months in overall loan sales. Quarter to date in Q4, we've already done close to $1 billion in sales across our products as well. So the demand is certainly there. We will continue to fulfill on both ends, but as Anthony mentioned, being able to originate on behalf of others is purely incremental to us.
The next question comes from Kyle Peterson from Needham & Co. Kyle, your line is open. Please go ahead.
Great. Thanks, guys, and good morning. Nice results. Wanted to ask a question on deposits, some of the trends you guys are seeing there. You guys had really nice growth there, despite, I believe you took down the rate paid on member deposits a bit, as rates have gone down. So just any color on whether you've seen any changes in average balances or customer behavior, or if things have been pretty receptive to some of the changes you guys have made on deposit rates kind of early on in the rate cut cycle.
Yeah, we're really proud of the way the SoFi Money product continues to resonate in the marketplace despite rates coming down more broadly. We've maintained our market share position. We've maintained our ranking in an APY standpoint. Of course, we do not charge fees. We obviously give a number of other benefits, including the high interest rate, not to mention all the functionality you need in one place. So we've seen continued strong trends in deposits, over $2 billion of member deposit growth in the quarter. In addition to that, the spending levels that we're seeing are on par to better to where they have been historically. And so we're continuing getting positive indicators across the entire business as it relates to SoFi Money. The other thing I would just mention is this is one of the key points of where the flywheel starts. Our direct deposit customers are customers that are more engaged. They have meaningfully higher number of products per customer compared to the overall average that we report. And when you look at it on a vintage basis, it's even better than the overall average number of products per direct deposit member. So it's been over a year in which we've operated this business as a bank and been able to control our own destiny and having a competitive advantage in being both an origination platform on loans, as well as a national bank that can set its own interest rate and its own value proposition. It's a competitive advantage, and one that's continued in the quarter, and we're excited about next year.
The next question comes from Mihir Bhatia from Bank of America. Mihir, your line is open. Please go ahead.
Good morning. Thank you for taking my questions. I wanted to stay with the financial services segment again. And I wanted to just talk about a couple of things there. One is just about monetization in the segment. I think it's up to $81 annually now. Any targets you can share on what you think that can look like maybe this time next year, or just, to achieve your 3-year targets that you laid out? Like, how much more monetization can that be? And then just related to that, I guess, what is the next growth there? You mentioned SMB and Protect in your remarks. You also launched the credit card more broadly. So maybe talk to us about where that next growth vector is materializing from. I guess really what I'm asking is what's the next lending platform business in that sector, right? Like, I think it was a pretty big surprise for a lot of people how much that business grew this quarter. So give us
You've hit the nail on the head, thank you. You've hit the nail on the head. It's an exciting part of our business. The fact that we're approaching, $1 billion annualized business, very profitable while we're still in investment mode. It's pretty amazing to have a business of that size, $238 million of revenue, growing over 100% and profitable, despite how fast we are growing the number of members and products and revenue per product. And I think the best way to sort of conceptualize where this business could go is to think about those three variables: member growth, product growth, and revenue per product. The revenue per product that we generate today was up meaningfully in the quarter, as you mentioned, but it's nowhere near where it can be long term. As it relates to our invest business, we're monetizing at about half the rate that we think we can monetize it over time. In 2025, we'll take a number of steps where we start to monetize that better, of course, by adding incremental value to the invest experience. Our invest product is unique in that we're trying to be a one-stop shop just within invest. We pioneered fractional shares. We obviously don't charge on trades. In addition to that, we created our own ETFs that would better meet the needs of our new and beginning investors that are a lower price point but diversified, allowing our members to do dollar cost averaging in a diversified way. We have award-winning robo accounts, and we continue to evolve those, and you'll see us do more in 2025 behind that, to not just grow assets, but also to increase monetization. We do IPOs, which is a direct monetization vehicle, but again, a unique product where Main Street investors get access to IPOs at IPO prices. And then our alternate asset classes and mutual funds that we launched have really been a tailwind for us in terms of driving more engagement. That's something today that we don't monetize that we will monetize in the future. So just in the invest business, we have a over 100% opportunity to increase the monetization per member, not to mention the fact how fast the products and invest are growing. And remember, when you do the calculation on invest product growth, you have to normalize it for the lost crypto members or products that we had a year ago that were transferred. Sofi Money Business, we continue to see nice trends in deposits and spending, and the monetization there will continue to improve with more deposits and more spending as opposed to a change in rate per se. In addition to that, our credit card business is another source of monetization opportunity. As balances continue to increase, we'll have more monetization there. In addition, the more members that we add, the more monetization that we drive, because that's a higher interchange revenue than our debit interchange. And so as you see a mix shift, you'll see an improvement in monetization there, not to mention just the absolute increase in monetization. And then as it relates to small, medium business, we're just scratching the surface. The biggest initiative we had so far in 2024 was to take the application process and embed it into the SoFi app. So when all the demand that we get for small and medium business comes to SoFi, they can, within the native app, apply for a loan and then be referred to a partner as it relates to lending. We also do that as it relates to banking. You'll continue to see us do that in a much bigger and broader way. There is monetization there today, but we could do more products and more services to drive greater monetization, not to mention doing it ourselves at some point, which we would like to do over time. It is a early stage business, and we want to crawl before we walk and then ultimately run. So you'll see that in the SMB business. On the insurance side, the deals that we're doing in the marketplace increase our monetization there, but it also increases penetration. So over 100% revenue growth in the quarter, driven by the really strong product growth and revenue per product. And if you just focus on those two measurements, you'll be able to forecast a pretty sizable business with great profitability. The last point I make on profitability is we're still losing a large amount of money in the credit card business and invest business because the payback there is
is longer, and it's not a business that we get return on in 1 year. It takes anywhere from 1.5 to 2 to 3 years, depending on the J curve of the credit business. So what's masking the profitability is that investment there. If we actually subtracted, added back the losses that we're losing there, the number would be even bigger on the profitability side, and that's before we've improved any of the monetization.
I found this on the web.
The next question is from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Nice trends here. I was just curious, if bigger picture, can we talk about what you're seeing in the alt credit side? Private credit certainly becoming a theme. Some of your marketplace lending peers have also benefited here. In your discussions, pipeline, just curious if you think this emerging as a larger theme over the next 12, 18 months. And then finally, as it relates to tech platform performance pipeline, can you talk to the degree of decision delay you're seeing currently versus last quarter? Thank you.
Yeah, in terms of the demand for our loans from buyers or investors, similar to other people, the demand has increased quite meaningfully. We are better at being able to meet some of that demand by continuing to evolve our business from origination platform for our own loans and now the evolution of the loan platform business. So similar to others, we're seeing an increase of it from existing buyers, but also a number of new partners that we've not been able to meet their needs with before, but we now can. So really excited about declining rate environment, putting a tailwind behind the loans, not to mention our new initiatives there. As it relates to the tech platform, no decisions have been made by any of the big deals that we've been in process with over the last 12 to 18 months. I do think we're coming to the end of some of those decisions being made, and I would just say that we haven't had anything to announce, but I would just tell you I'm confident that we will have some wins there, but none of the decisions have been made on any of the large deals. And I would just give you more color on the types of deals. There are definitely big financial institutions that have to make some decisions on their technology. They continue to really struggle with how they budget for that transition, but without a doubt, there's a technical reason why they have to switch, there's a risk reason why they have to switch, and there's a regulatory reason. And so it's going to be an inevitable change and tailwind to the demand for technology like we have in our tech platform business, and specifically in core and processing. And it's just a question of when, and I think we'll win our fair share of deals there. But none have been decided yet. The second area that we haven't talked as much about in the past is the opportunity to help large branded companies that have big installed bases. They're in the financial services business already today through a credit card and a white label credit card. There's absolutely a significant amount of demand from those types of partners for us to do something very similar on the debit side of the business. And we continue to receive RFPs for that type of product. And then, of course, outside of the direct-to-consumer businesses, there's demand from government agencies, there's demand for B2B companies that continue to surface, and some of which we've signed and executed against, some of which will be decided over the coming months.
Next question comes from Jill Shea from UBS. Jill, your line is open. Please go ahead.
Good morning. Thanks for taking the question. You launched the Everyday Cash Rewards and the Essential credit cards while early days. Can you just talk about the early indications there and your view of future growth on the card products?
Yes, we really like the card business long term. It obviously is an expensive endeavor near term. There's a J curve of about 3 years in that business. We have a world-class team that's done this before. That wasn't the case when we first launched. The two cards that you mentioned are a direct result of all the work the team, our second team that came in to run this business has done. We did a test with the business. We saw the type of performance that we were hoping to see. Our marketing capabilities there have also helped us deliver the type of performance we wanted to see in those cards, and that's why we went general availability for those cards as opposed to just testing. I will say we will take a very methodical approach to the credit card business. While it is a great ROE business, it also does have the ability to lose a lot of money and lose money every day. And so we'll continue to make sure that that card is something that we market to individuals that we think have a high probability of utilizing it in the right way, and we can get a great return on it. So we'll start with our members, and we'll continue to use the data that we have on them to make decisions. We can use that data to model opportunities off of our platform, which we are starting to do as well. Inside of the financial services business, think about it as a couple of different types of segments. We have businesses that are still growing very fast that are profitable, like SoFi Money. We have businesses that are growing very fast and are losing money, like Invest and Credit Card. And then we have businesses that are early stage, and we're planting seeds that will continue to be harvested over time and grown over time. And this is a business that's in the middle, one that we feel we're confident in terms of our go-to-market, and one that will grow, but we'll do it methodically over time to make sure that we do not push too hard on the investment we have to make and offset the profitability of our overall business. But it'll be a good contributor.
At this time, I would like to turn the call back over to Anthony Noto for closing remarks.
Thank you, operator, and thanks for everyone that's dialed into the call. I have some closing remarks I want to share. As I mentioned at the end of Q2, I could not feel better about what we've achieved and where we're headed right here and right now. The list of achievements is far too great to capture every quarter, so let me be succinct and clear. Despite the tumultuous environment of the past 7 years, we've delivered durable growth, world-class innovation and brand building, and improving returns with 17 quarters of record revenue, consistent 35% plus growth in members and products, 4 quarters of GAAP profitability, and so many other milestones. There is only one reason we've been able to emerge stronger from such a tumultuous environment, and that reason is the people of SoFi, our employees, our members, and our clients. I could not be prouder or more grateful to the people of SoFi. We now face, hopefully, the most advantageous environment that we've seen since I joined the company, and we began the relentless march to be a one-stop shop. Today, we are no longer just a lending company. Today, we are a force to be reckoned with. It is truly our time as we have more products, more members, more capital, and more diverse revenue streams than ever before. We are undeniably the absolute best positioned company to capture the massive opportunities still ahead of us because of the same thing that got us here, our people. Our people are great at heart. Thank you, everyone, for your time today, and we hope you have a great end to 2024.
Okay, everyone, so that was the end of the call. So overall, I would say it was a pretty good call. Again, just kind of representing the increase in guidance, the overall forecasting, beats on EPS, revenue, strong potential opportunity over the next 5 to as many as 10 years. And of course, expectations are very, very strong, well over 50% increase on a year-over-year basis, annualized over the next 5 years, representing SoFi, as per my calculations I've discussed earlier in the live stream as well, to be sitting at just about $9 to $10 per share. You can pretty much do that on your own on our platform as well. So if you come over to SoFi, simply look at the analyzer tool discounted earnings model, and this year's earnings are going to be roughly around $205 million. So that's what we're going to plug in here. Growth rate, analysts are pricing in for 56 to 57% as we calculated earlier. But even if you go with a modest 30% growth rate with a 30 times P multiple, somebody was asking about what the P multiple is for SoFi, right now sitting at about 105. And if that number starts to come down closer to 30, even then, SoFi at $9 makes a lot more sense at a modest 30% growth rate and a 30 times PE multiple. So that's where we are. 11.25 is where the pre-market price is. It has sold off 6% pre-markets. We have seen definitely a little bit of a sell-off, 6.5% after the earnings call began, and a reversal in PayPal. So we did see PayPal, of course, sell off initially, get bought back up 12 to 14%, then sold off once again down to $77 lower than where the candle closed previously, and then another 8% rally here. So it's been really, really volatile over the last hour or so. And of course, SoFi moving in the opposite direction, popped up right after the earnings, and it's giving back on almost all the gains here. Pre-market, it's now actually down 60 basis points at the moment. But of course, it's also heavily shorted as well. So it's really not that far off from the fair value that it's, the fair value that we've calculated at $9.21. And you can pretty much look at the expectations from the P multiple and the growth rates as well. And if you, again, look for, let's say, a lower growth rate of 25, giving them, let's say, a 30 times P multiple or a growth rate of 25%, then, of course, your fair value drops down to $7,750, in and around those levels, right in the mid to low sevens is where the fair value will drop down to. So it really depends on where you as an investor feel comfortable about SoFi over the long term. It is a company that's turning the corner towards profitability, which is a pretty big deal. It's always a very good deal from an investor standpoint, from an analyst standpoint. But really, the long-term growth rate is up for debate, whether it's going to be 20%, 30%, 50%. That is, of course, up to debate here. What is going to be that growth rate for the long term? So that's it for SoFi. PayPal, we also discussed briefly. I didn't really listen into the earnings call, of course, because we had a bit of a poll here to listen to the earnings call for SoFi. But I'm going to catch up on that later today as well. And Tom says, I keep waiting for these fair market values. The prices keep going up. Well, that's the disciplined approach to investing, right? You don't have to wait for them. You've got your buy targets ready. So it's up to you, right? So if I can ask you, Tom, what's your fair value on SoFi, right? What's the price that you're comfortable buying, or what's the price that you feel is going to be appropriate for SoFi? So that's really the whole question. That's really the whole idea. It's like everyone's got a different fair value. So if your fair value for SoFi is $12, you're going to be buying it all day long, versus somebody who sees their fair value to be $8. And there's nothing wrong with that. You can see the fair value has a pretty wide range from $4 all the way to $14.82. So that's the sensitivity grid. And what is that based off of? Two metrics, your growth rate and your PE multiple. So if you feel that SoFi is going to be able to grow, so $9.50, there you go. $9.50 is your fair value. Right now it's trading at $11. So you're going to be a little bit more patient for the price to come down. But at the same time, if you want to avoid letting the stock get away from you, you can either sell puts, or you can also start dollar cost averaging a little bit in smaller quantities, because there's always going to be a wider range based on all the different inputs that we plug in, right? At different growth rates and different multiples, you've got different fair values. So that's the whole idea behind the analysis and letting math do the work for you, is that you're not emotional. You're letting the numbers do the work for you. And calculating it based on the different assumptions. And there's going to be a wider range, and that's the whole point. It's not supposed to give you a specific number, but instead, based on the different assumptions for growth and multiples, it's supposed to give you a wider range so that you can kind of formulate a decision around it. So for me, if the fair value is, let's say, at $9.40, $9.50, similar to yours, I would be comfortable picking up shares even at $10, right? It's not going to be a big deal if I buy at $10. In fact, I think I picked up at $11 last time. Then I bought shares here, sent out the alert at $11, of course, sold calls immediately at $15, $16. And we'll be looking to, of course, load up even more if it drops down to $10, $9. Anything under $9, then, SoFi becomes a bit more undervalued as per my analysis. But PayPal here is, now that the script has turned a little bit, PayPal was green just a few minutes ago, and SoFi, of course, coming down on a pre-market basis. And then we got Palantir here also hitting new all-time highs yesterday to well over $44, $45, essentially flat pre-market at the moment. So market open is going to be just 20, 22 minutes away. The charts for those stocks look super bullish. Yes, they're very, very strong to the upside on the daily time frame. You can see that Palantir has just been pushing higher. SoFi also very, very strong. Again, incredibly overbought as well. So there's a possibility for some profit taking as well, given how overbought it is on the RSI and the MACD. And of course, if you come over to PayPal, it's also been very similar. So all three of these stocks, Palantir, PayPal, SoFi, they've all been pushing higher very aggressively. PayPal is up from its lows of $57. It's rallied over 46%. And again, pre-market, it's down about 1.5% at the moment. So that's where we are. That's the entire earnings breakdown. I'm going to go live again in just a couple minutes. I'm going to switch the live stream to the market open because right now this is going to be for SoFi earnings. So it's going to be coming out as a separate video, and then I'll be going live again here in just a couple minutes. I'm going to turn off this live stream and start a new one just to go over the market open here. So again, see you guys shortly. Thank you so much for joining. Happy investing, and I'll see you.